Welcome to This Explainer. Today, we're cracking the code on market capitalization to find a company's true price tag. Imagine having an unlimited budget. What would it literally cost to buy up an entire corporate empire? That massive theoretical price tag to own 100% of a company, that's its market capitalization. The math is super simple. Just multiply a single share's price by the total number of shares out there. Let's make this real. We're going to look at the consumer goods powerhouse Hindustan Unilever, or HUL. They're a total giant, making the exact soaps, shampoos, and detergents you probably use every single day. At the time of this analysis, just one share of HUL cost 2,190 rupees. And the total number of shares in existence? A mind-blowing 216 crore. Put those two numbers together, and you get the remarkably simple math to figure out the company's size. Literally, just multiply that single share price by the total number of outstanding shares. It's that easy. Boom. Roughly 5 lakh crore rupees. That staggering number is HUL's total market capitalization. So, if you magically had exactly 5 lakh crore rupees burning a hole in your pocket, what's next? Well, you've got options. You could buy HUL, or you could snap up the IT titan Infosys. You could buy all of Infosys and actually have 300 crore rupees left over as spare change. Or compare HUL to HDFC Bank. It has a nearly identical 5 lakh crore market cap. So it begs the question, do you want a soap company or the country's largest bank? It's exactly like a kid with 10 rupees choosing between chips and chocolate. Your capital is limited. Comparing market caps across industries gives you a massive measuring stick to intuitively invest your limited funds. Now that you know the true price tag of these massive empires, where will you invest next?
Ready for a quick explainer? Let's crack the hidden math behind how banks actually make their cash.
You probably think banking is just simple math. Well, the reality is way more fascinating.
Imagine this. Your bank pays you 5% interest on savings, then lends it out at 12%.
So on a 100 rupees deposit, they pay 5 rupees, earn 12 rupees, and keep a 7 rupee spread, right?
Wrong. Here's the catch. Banks don't actually get to pocket that entire 7 rupees spread.
Why? Because strict rules say banks must park a chunk of those funds safely with the central bank.
To see this in action, let's say a bank collects 500 rupees in total deposits from us. They owe 5% interest on that entire 500 rupees, so they absolutely have to pay out 25 rupees. But thanks to those mandatory safety reserves, they can literally only lend out 400 rupees of it.
Now, here's where the math gets genuinely wild. When they lend that available $400 out.
Earning 12% on 400 rupees means the bank collects 48 rupees in total interest from its borrowers.
Subtracting the 25 rupees they owe from the 48 rupees they earned leaves just 23 rupees of actual income.
This perfectly highlights the banking industry's holy grail metric, net interest margin, or NIM.
NIM is the real percentage a bank keeps from total deposits after balancing all this out.
Take HDFC Bank, for instance. This massive franchise typically operates with a NIM around 4%.
Meaning for every 100 rupees you deposit, they actually only keep about 4 rupees in interest profit.
It's a tiny slice, but crazy powerful at scale.
So what's your bank's NIM?
Hey, let's dive right into this explainer and figure out how to evaluate a bank's actual growth potential. Seriously, why do some banks explode with new loans while others just totally stall out? Well, in a growing economy, the demand for business and personal loans is literally infinite. But here's the catch. A bank can't just lend out infinite cash, even with lines out the door. To avoid going completely bust, banks absolutely must hold on to their own strong safety reserves. We measure these vital safety reserves using something called the Capital Adequacy Ratio, or CAR. Think of a bank like a car. Loans give you speed, but CAR, that's your fuel tank. You literally cannot hit the gas and grow without enough of that capital fuel in the tank. So what's the magic number here? It's 17%. A CAR around 17% gives you a massive, rock-solid cushion to safely expand those loans. This massive buffer explains exactly why banking giants like HDFC and Kotak show such aggressive growth. They have enough capital stockpiled to confidently hand out more money without risking the whole operation. But wait, what actually happens to a bank running low on that safety buffer? Look at South Indian Bank, for example. They sit way lower, hovering around just 12%. With less capital, strict safety regulations severely limit their ability to actually pump out new loans. And you know what destroys capital? Bad loans. They eat directly into the bank's precious fuel. If your car drops from those bad loans, your future lending and growth just hit a brick wall. On the flip side, pulling in cheap deposits through savings accounts massively boosts both profitability and capital. So the formula is simple. Low bad loans plus cheap deposits equals high CAR and explosive growth. And guys, this secure growth ultimately leads to way higher returns on equity for the bank. So, before buying your next banking stock, ask yourself, how much fuel is really in their engine? Welcome to The Explainer. Let's peek under the hood and uncover the hidden costs of banking. Banks need money to lend, right? They use your deposits. But what's the actual cost to them? Current accounts are basically freebies. Banks pay literally 0% interest to hold that money. Savings accounts, though, those usually cost a bank around 3.5% in interest. Fixed deposits are way pricier. So, naturally, banks crave those cheap current and savings accounts. This brings us to the famous CASA ratio, the percentage of total deposits from those cheap accounts. People assume a high CASA ratio automatically equals super cheap money. Well, let's test that. Check out this real-world comparison between Kotak and HDFC. It reveals a huge trap. Kotak boasts a massive 52% CASA ratio, while HDFC sits at 42%. Kotak wins, right? With more CASA, Kotak should definitely be getting cheaper money. But hold on a second. To hit that 52%, Kotak aggressively marketed a massive 6% interest rate on savings accounts. Paying 6% completely ruins the whole point of gathering those cheap savings accounts. Enter the ultimate metric, cost of funds. It tracks the true average interest paid across all deposits. Look here, despite a lower CASA ratio, HDFC actually has a much lower overall cost of funds. HDFC pays just 4.88% on average for its money. They are vastly more efficient than Kotak. Cost of funds proves HDFC gets genuinely cheap money, completely skipping those expensive marketing gimmicks. Next time you evaluate a bank, check their cost of funds. Are you just falling for marketing?
Ever wonder why banks are practically begging you to open a savings account? Let's figure it out.
The absolute secret sauce to bank profits, it's a crucial metric called the CASA ratio. So CASA simply stands for the percentage of deposits coming from current and savings accounts.
Think of these deposits as the essential raw material banks buy to create their loans.
This is exactly why CASA is king. Fixed deposits are expensive, but CASA money is incredibly cheap.
In fact, banks pay absolutely 0% interest on most current accounts. It's literally free funding.
Here's the math. A bank takes your 4% savings and turns around, lending it at 12%.
That leaves a massive 8% profit spread. They literally just keep the difference.
Emerging banks will use a bait and switch. They'll offer 7% to lure you in, then drop it.
Newer banks like IDFC First offer 7% to build CASA, while giants like SBI offer just 3%.
But hold on, is a higher CASA percentage always a guaranteed slam dunk win for a bank?
Take a look here. Kotak boasts a massive 52% CASA ratio compared to HDFC's 42%. Kotak wins, right?
Not exactly. The real test is the cost of funds, the average rate paid across all deposits.
Check the data. HDFC actually manages a lower overall cost of funds at just 4.88%.
Because Kotak paid higher interest to get that CASA. A high ratio only matters if it's actually cheap.
Next time a bank offers you 7%, ask yourself, are you the customer or just cheap raw material?
All right, let's jump right into this explainer on a financial concept that literally changes everything. Are you looking at totally wrong numbers when valuing a stock? Honestly, you probably are. Imagine running a business. You work hard, grind out sales, and bring in a solid profit. But what happens if you invest some of those profits into your friend's business? This perfectly illustrates the concept. Your own direct earnings, that's your standalone statement. But your income plus your friend's business payouts, that's the consolidated statement. See the difference? So, a consolidated statement combines the parent company's direct operations with all its investments and subsidiaries. Let's look at a massive real-world example to put this into perspective. Take Tata Motors. Looking at their standalone statement, Tata Motors' yearly sales sit right around 70,000 crore. Sounds huge, right? But wait, what about Jaguar Land Rover, which Tata acquired? When JLR is factored into their consolidated statement, those sales absolutely skyrocket to 3 lakh crore. Just look at these two side by side. The difference in scale is literally mind-blowing. It's a jump of more than 4 times the original standalone number. That's insane. So, if you judge a stock just by its standalone statement, you fall into a dangerous trap. It literally always gives you the wrong picture, making the company look artificially expensive. To really get a company's financial health, you absolutely have to check the consolidated data. It's the only way to get the true, complete picture of its total scale and wealth. So, what hidden wealth might you be missing in your next stock analysis? Always check consolidated.
Let's clear up a massive investing misconception today using just a simple 10 rupee pencil.
So, you buy a pencil for 10 bucks and sell for 15. What's your profit percentage?
Sounds super simple, right? 10 rupees cost, 15 to sell, leaving a cool 5 rupee profit.
Well, the actual percentage completely changes depending on whether you're calculating markup or profit margin.
Let's look at markup first. This metric is strictly tied to your original cost price.
Earning 5 rupees on a 10 rupee cost, that gives you a massive 50% markup.
Profit margin, on the other hand, is calculated purely against your final selling price.
That exact same 5 rupee profit on a 15 rupee sale, your margin is actually just 33.3%.
It's literally the same transaction, but totally different metrics. Markup uses cost, margin uses sales.
Definitely remember this golden rule. Margin always comes from selling price, while markup comes from cost.
So why do smart investors absolutely obsess over this exact difference when looking at a business?
It all boils down to return on equity. Basically, how fast a business multiplies its cash.
Imagine Ram sells pencils at a 50% margin, but Shyam sells at 33%.
Because Shyam's price is lower, he easily sells 30 pencils today, while Ram sells just 10.
By taking a smaller margin but pushing higher volume, Shyam literally skyrockets his daily profit.
Ram bags 100 rupees sure, but Shyam makes 150 using the exact same starting capital.
This totally proves a crucial secret. Sky-high profit margins absolutely do not guarantee a better business.
Selling tons of volume at lower margins often creates way better returns through rapid inventory turnover.
So, looking at your next big investment, are you hunting for high margins or high turnover?
Let's jump right in. Want to instantly figure out if a stock is actually profitable? We're breaking down EPS. With all that financial jargon out there, how do you know what a company is really worth to you? The answer is earnings per share, or EPS, total net profit divided by total shares. It's that simple. Forget the complicated Wall Street math for a second. Let's look at a regular neighborhood shop. Imagine this little shop pulls in a total net profit of exactly 100 rupees this year. But there are 4 equal partners running the place, so the business is split into 4 shares. Here's the magic math. Take that 100 rupee profit and just divide it by those 4 shares. Boom. The earnings per share is exactly 25 rupees. That's the actual profit for each owner. Okay, so how does this actually play out in the real world with massive companies? Let's look at a giant, Hindustan Unilever, easily one of India's biggest consumer goods companies. Believe it or not, the exact same math applies to a multi-billion-dollar corporate empire. Despite billions in profit and crores of shares, their actual EPS is a totally relatable 28 rupees. If one share costs 2,190 rupees but only earns 28, is it worth it? This is why EPS is critical. It's the absolute building block for the price to earnings, or PE ratio. Just divide that massive share price by our newly found EPS of 28 rupees. The result is 70. You're literally paying 70 times the 1-year profit just to own this share. Seriously, ask yourself, would you pay 70 bucks for a shop that yields just 1 rupee annually? EPS cuts through the noise. It calculates your exact profit cut and spots the truly overvalued stocks. So what is the EPS of the heaviest hitter in your portfolio right now? Go run the numbers.
Hey there, welcome to this explainer. Let's track the smart money trail and decode true insider confidence.
How do you actually know if founders believe in their own business? Simple. Check their personal shareholding.
This is promoter holding, the exact percentage owned by the founders. It's ultimate proof of skin in a game.
For traditional companies, a healthy baseline sits right around 40 to 50%.
That shows some serious commitment. But wait, a high static percentage alone, that can be a dangerous illusion. You definitely can't stop there.
And/or pledged shares. This happens when those same founders actually mortgage their own stock to secure bank loans.
So, a 57% holding looks great, but if 82% of that is secretly pledged, yeah, massive red flag. It signals major cash desperation. Plus, banks can forcibly sell those shares, instantly crushing any perceived insider confidence. The real secret sauce here is tracking the quarter-on-quarter trend. Are insiders steadily buying or quietly selling off?
Take Tata Chemicals, for example. Their promoter holding steadily ticked up quarter-on-quarter, from 30.6 to 31%. This steady upward trend, absolutely the ultimate green flag. Meanwhile, a falling trend screams serious financial distress.
But hang on, what if a company has basically zero promoter holding? Is it automatically a terrible investment?
Not always. Startups heavily dilute equity, regulations strictly cap banks, and some massive companies are entirely professionally managed.
So when founders can't hold shares, you've got to follow the financial heavyweights to uncover those hidden market signals.
I'm talking about institutional experts, domestic players like mutual funds and FIIs, the massive foreign institutional investors. If these heavyweights steadily increase their stakes quarter-on-quarter, it acts as a totally critical, validating safety net.
To wrap up, check baseline holdings, ensure shares aren't secretly pledged, and obsessively track those quarter-on-quarter trends.
Add your target stocks to a watch list. You'll get instant alerts the moment promoters or institutions make moves. So before investing a single rupee, ask yourself exactly who is betting their own hard-earned money today.
Okay, let's dive in and uncover the hidden risk that really determines a bank's true financial health.
It all comes down to one absolutely crucial question. What happens when a bank's loans don't come back?
Enter net NPA, or non-performing assets. It's basically the exact percentage of total loans that have actually defaulted.
So imagine a bank lends out exactly 100 rupees to various everyday borrowers in the market.
The terrifying question for us as investors is, well, how much of that 100 simply vanishes forever?
To really see this in action, let's look at the lending quality of two real-world Indian banks.
Back in 2019, HDFC's net NPA was a tiny 0.4%. Central Bank, near 8%.
Meaning, for every 100 rupees lent, HDFC lost just 40 paise. Central lost 8 whole rupees. Insane, right?
Because at its core, banking is literally just a high-stakes game of predicting who will actually repay you.
When borrowers default, it sets off a massive domino effect that directly destroys the bank's core capital.
And, without that capital, the bank's future growth and ability to issue new loans basically dies.
But if a bank actually masters this risk, they unlock the ultimate winning formula for a great franchise. Controlling bad loans preserves capital, which then drives massive loan growth and eventually absolutely soaring profits.
That's exactly why banks with low NPAs directly boost returns and consistently generate massive wealth for investors.
So, before you trust a bank stock with your hard-earned money, have you checked their net NPA?
Welcome to The Explainer. Today, we're finally clearing up the confusion between margin and markup.
Okay, let's dive right in. Do you catch yourself mixing up these percentages when checking a company's profitability?
They sound super similar, but they actually tell totally different stories about a business's success.
Let's break it down. Imagine a business buys a simple pencil for exactly 10 rupees.
Then, they turn around and sell that exact same pencil to a customer for 15 rupees.
So the crucial takeaway here is the absolute profit on this transaction is exactly 5 rupees.
First up, markup. This metric is calculated strictly against that initial 10 rupee cost price.
To find it, we divide that 5 rupee profit directly by our 10 rupee base cost.
That gives us a massive 50% markup. Sounds incredibly impressive, right?
But what about profit margin? Well, this metric relies entirely on the final selling price instead.
Now you divide that exact same 5 rupee profit by the larger 15 rupee selling price. Doing that reveals your net profit margin is actually only 33.3%.
See that? The exact same 5 rupee profit yields wildly different financial percentages. Pretty crazy.
Here's your golden rule. Markup looks backward at cost, while margin looks forward at total sales.
So, which metric are your investments using to report success? Check their reports and stay curious. Welcome to This Explainer. Today, we're demystifying the actual engine behind how banks print their profits.
Seriously, what really happens to that money just sitting around in your bank account? It's simple.
Banks borrow your deposits dirt cheap, then lend that exact cash out at much higher rates.
Their absolute cheapest money, that comes from CASA, current and savings accounts.
Since current accounts literally pay zero interest, having a high CASA ratio is a massive profitable advantage.
Let's look at Kotak. They built a 52% CASA ratio, way higher than HDFC's 42%.
But wait, here's the catch. A higher ratio doesn't automatically mean cheaper funds for the bank.
Kotak aggressively paid higher interest to attract savings, so their actual cost to get those funds stayed high.
Meanwhile, HDFC pays an average of just 4.88% overall. That is incredible operational efficiency.
So, how does the spread turn into pure profit? Let's break down the math real quick.
Imagine a bank gathers 500 rupees at 5%, holds 100 in reserve, and lends out 400 at 12.
The bank pays out 25 rupees to depositors but pulls in 48 rupees from its borrower. Subtract that 25 paid from the 48 earned, and the bank keeps a positive 23.
That 23 rupees, that's net interest income. It's their core earnings before any operating expenses kick in.
Turn that income into a percentage of total assets, and boom, you've got the net interest margin.
HDFC brilliantly holds a net interest margin around 4%, which is basically an industry gold standard. Simply put, for every 100 rupees resting in their system, they efficiently extract a 4 rupee margin.
So remember, banking totally relies on maximizing cheap deposits, keeping costs low, and protecting those healthy margins.
Next time you check your savings rate, ask yourself, how efficiently is your bank profiting off of you?
So, how do you spot a sinking company before it totally wipes out your hard-earned money?
Well, the absolute best clue to uncover a company's real financial health is its shareholding pattern.
Okay, let's dive into this. We're going to start our investigation with the ultimate insiders, the promoters. The golden rule here, a healthy company usually keeps a promoter holding of at least 40 to 50%.
But hey, static numbers don't tell the whole story. You've got to watch their buying and selling trends over time. And this brilliantly illustrates why. Promoters buying screams confidence, but then jumping ship? Yeah, that's a massive red flag.
Now, what's really interesting here is the terrifying plot twist of pledged shares. It's a total hidden trap.
Think about it. A massive holding literally means nothing if those shares are just mortgaged to banks.
Seriously, if promoters are aggressively dumping heavily pledged shares, that company is screaming absolute danger. Stay away.
Let's move on and see how this builds. Meet our expert witnesses, the DIIs, basically the domestic smart money.
And right alongside them, FIIs, or foreign institutional investors. These global heavyweights are tracking the stock's every single move.
When these giant institutional heavyweights increase their investments, it's literally the ultimate validation of a company's financial safety.
Take Tata Chemicals, for example. Promoters, DIIs, and FIIs all consistently showed massive confidence over multiple consecutive quarters.
So the crucial point is always run this simple 3-step financial background check before investing a single dime. Now it's your turn to play detective. Have you checked the shareholding patterns hiding inside your own portfolio?
Okay, let's dive into this explainer. We're going to learn exactly how to spot dangerous stock market illusions.
Because guess what? Companies can and do legally manipulate their sales to trap unsuspecting investors.
That massive quarterly profit you just read about? Yeah, it might be a total mirage.
And this brilliantly illustrates the trick. They record fake sales on December 31st, accepting returns on January 1st.
Insiders cash out on the hype, fully knowing those returns will absolutely crush the next quarter's numbers.
Think about buying pencils for 10 grand and selling them for 15 on credit. Then the check bounces.
Your book showed a 5,000 rupee profit for months, right? But your actual cash flow is zero. So, the crucial point is P&L statements only show expected sales, not cold, hard cash.
To cut through the fluff, we need the ultimate lie detector, the cash flow statement.
Specifically, the CFO to PAT ratio. It measures exactly how much paper profit actually turns into real money.
And here is the golden rule, guys. For a healthy business, this ratio absolutely must be 0.8 or higher.
Meaning, for a company to be safe, actual cash generated must be at least 80% of reported profit.
Let's move to and see how this builds in the real world with two very different companies.
Take Godrej Consumer. Over 5 years, their operating cash flow is insanely close to their reported profit. This near 1.0 ratio, it proves their sales are legit and their accounting is super trustworthy.
Contrast that with Lovable, a reported 50 cores in profit but only 21 cores of actual cash. Now, what's really interesting here is this dangerous gap. It's a massive, glaring red flag for investors.
Cox and Kings is the ultimate warning. Constant paper profits while their cash flow was deeply negative.
This ratio is literally your best shield. It catches fake sales, exposes bad credit, and verifies actual health.
So, take a hard look at your stocks. Is your portfolio built on cash or just paper profits?
Welcome to This Explainer. Think massive founder investment guarantees a stock's safety? Well, not exactly.
You see founders owning 60% and think jackpot. But guys, that isn't always true.
A promoter is just the owner. If they've got serious skin in the game, you usually can too.
So, as a general rule of thumb, you want to look for promoter holding above 40%.
It's like a friend's startup. If they're risking their own life savings, that is a huge green light.
Take Z Entertainment. Right on the surface, it looks fantastic. A massive 57% owner holding.
But here's the catch. A massive holding percentage on paper can actually be a total financial illusion.
Look at this trap. 82% of those promoter shares were literally mortgaged to the banks.
Pledged shares mean the owner is totally cash-strapped, mortgaging their own ownership just to survive. Red flag.
If the business stumbles, the bank seizes and dumps those shares, absolutely crushing the stock price.
So wait a minute, are there ever any real exceptions to that 40% rule? Actually, yes. Certain business structures literally demand low or even zero promoter holding by design.
For instance, ITC is phenomenally successful and professionally managed, with literally 0% promoter holding.
Banks are another huge exception. Strict RBI rules prevent single owners just to stop monopolies. Okay, outside of those specific exceptions, how do we spot a truly healthy ownership trend?
Well, look at Tata Chemicals. Quarter after quarter, the owners are buying more of their own stock.
When promoters actively increase their holdings, it's honestly the absolute strongest signal of internal business confidence. All right, let's quickly summarize your ultimate ownership toolkit moving forward.
Above all, verify those pledged shares. High holding means literally nothing if a bank secretly owns it.
So, go check your portfolio today. Are you holding a secretly pledged time bomb right now?
Welcome to The Explainer. Today, we're exposing a massive stock market illusion, the face value trap.
Okay, let's dive right in. Is a 2.5 rupee stock actually cheaper than a 56,000 rupee one?
Back before digital trading, shares were physical pieces of paper. The price printed right on them, that's face value. Now, MRF and AdLabs actually share the exact same face value. They're both 10 rupees.
But MRF trades astronomically high at 56,000 rupees. It totally ignores that tiny initial price tag.
Meanwhile, AdLabs trades at just 2.5 rupees, which totally tricks beginners hunting for a cheap bargain.
So here's the crucial point. Directly comparing market price to face value is a massive, costly investing mistake.
Think of it like metal weights. 10 grams is literally just a measurement, right?
Face value is that 10-gram weight, but the actual material, iron versus gold, dictates the real market price.
So what does it actually do? It basically just represents how initial capital was divided when a company started.
For instance, split a 1 lakh rupee capital into 10,000 shares, and your face value is 10 rupees.
But if that exact same company issues 1 lakh shares instead, the face value drops to just 1 rupee.
The ultimate takeaway here? Completely ignore face value when deciding if a stock is cheap, expensive, or worth buying.
So, if face value is just a trap, what metrics should we actually use to value a stock?
Welcome to The Explainer. Let's jump right in and decode this corporate action called a bonus issue. Hearing bonus sounds like a total windfall, right? But is it actually free money for your portfolio? Spoiler alert, it's totally a myth. Let's break down the mechanics to see why there's zero immediate benefit. Imagine a 1-for-1 bonus issue. You started with 100 shares and boom, suddenly you have 200. But here's the catch. The company's total funds, say 3,000 rupees, stay exactly the same. Since you didn't actually pay for those extra shares, the company receives absolutely zero new cash. It's just simple math. Because the total share count just doubled, the book value per share literally halves. The market price and book value drop? Sure. But the share's original face value, that stays totally untouched. Think of it like a pizza. The pie doesn't grow. Your actual ownership percentage is exactly the same. So if it's just a zero-sum game, why do companies even bother doing this? What's the real motive? Look at MRF. At 57,000 rupees a share, it's basically locked away from everyday retail investors. And companies can't just split their face value below 1 rupee to make those shares magically cheaper. So they issue a bonus. A hypothetical 10-for-1 bonus totally slashes that massive price tag down proportionally. Ultimately, this isn't some magical wealth creator. It's really just a clever tool to boost market liquidity. Keep this in mind during your next trade. Are you buying real growth or just a clever illusion?
Welcome to today's Explainer. We're tackling a crazy paradox. Could shiny new IPOs actually wreck your current investments?
Okay, let's dive in. Bull markets totally pull in massive IPOs. But wait, could they literally trigger a crash? Imagine your family has a fixed income. Out of nowhere, boom, a massive new college fee pops up.
So the crucial point here, money has to shift. You literally have to sacrifice one expense for another.
Right, let's shift gears. Watch how this exact same logic plays out on a massive macroeconomic scale.
Currently, the total market cap for all existing companies on the exchange, it's sitting around 200 lakh crore.
Then a huge new expense hits. The recent Paytm IPO alone sucked up over 11,000 crore rupees.
Add up mega listings like Paytm, Zomato, and Nykaa. Suddenly, the market needs a staggering 1 lakh crore.
Now, our incomes didn't just magically double, right? So where on earth is this giant pile of cash from?
It's a massive liquidity drain. People actually pull their money out of stable stocks to chase those shiny IPOs.
Yeah, investors dump giants like Reliance or HDFC for IPO hype, which totally kills the overall market momentum.
It's exactly like farming. High crop prices mean farmers overplant. In a bull market, promoters just flood us with IPOs.
And this perfectly shows how a massive oversupply, whether it's crops or stocks, eventually drags all the prices down.
This frenzy pulls in weak hands, new investors buying purely on hype and short-term momentum.
Compare that to strong hands. These are patient, long-term folks holding solid companies based on real financial fundamentals.
When the market even slightly dips, those weak hands totally panic and sell, making the crash way worse.
So, with this crazy liquidity drain from endless IPOs, how do we actually protect our own portfolios?
First up, avoid momentum stocks. Seriously, don't risk your hard-earned cash just chasing wild market hype.
The best fix is actually super simple. Just stick to safe, fundamentally strong, high-conviction companies.
Only buy what you trust. Ask yourself right now, could your portfolio handle a 50% correction without panicking?
Welcome to This Explainer. Today, we're demystifying a sneaky corporate action known as the rights issue.
Let's dive right in. Is a massive 60% stock discount actually a good deal?
A rights issue sounds like a sweet VIP gift, right? Extra shares at a dirt cheap price.
But beware the Trojan horse. Let's look at the cold, hard math of this supposed bargain.
Imagine a company makes exactly 300 rupees in total yearly profit. They launch a 2-for-1 rights issue. Suddenly, 100 existing shares balloon into 300 total shares.
But here's the catch. The company's total profit didn't magically increase. It's still just 300 rupees. Because of this, your earnings per share, or EPS, absolutely plummets from 3 rupees to 1.
We call this EPS dilution. Your slice of the profit pie just shrank dramatically.
Let's look at a real example to see how this puts you in a terrible double bind.
Say you own 20 shares at 150 rupees. You're offered 40 more at a steep 60 rupee discount.
You take the bait and buy those extra discounted shares.
You drop an extra 2,400 rupees on top of your initial 3,000 rupee investment.
Here is the trap. You've now invested 5,400 rupees total, but your earnings are stuck at 60.
You literally paid a 2,400 rupee premium just to stand perfectly still and maintain your earning power.
Okay, what if you pick option B? You simply ignore the offer and save your cash.
There's a harsh consequence. Other investors buy in, severely diluting the overall share pool.
By doing nothing, your 3,000 rupee investment sees its earning power actively drop from 60 to 20.
To recap, rights issues force extra spending, brutally dilute your EPS, and destroy intrinsic shareholder value.
So, the next time a company dangles a shiny discount in front of you, will you bite?
Hey there, let's dive right into a crucial financial metric for avoiding sudden corporate disasters in this explainer. So, what happens if a company faces a sudden emergency and has to pay off loans immediately? Those looming short-term liabilities and working capital loans, they can quickly become a massive financial headache. Enter the quick ratio. It's our hero metric for evaluating a company's ability to handle short-term obligations. It's basically a balancing act, weighing those immediate urgent debts right against the company's available liquid assets. Think of liquid assets as a financial shield. We're talking pure cash and highly liquid investments here. But imagine this nightmare scenario. What if all the company's money is just stuck in the market? If a loan is suddenly due in, say, 2 or 4 months, can they actually pay it? To survive, the golden rule is that this ratio absolutely must be greater than 1. Being above 1 ensures the company has more liquid funds ready than immediate short-term debts. For example, let's look at a super healthy company with a quick ratio of exactly 2. Having double the assets means they could pay their debts twice over. That's real financial stability. So before buying your next stock, will you check if they can actually survive a sudden emergency? Welcome to This Explainer. Let's decode a corporate action that always gets retail investors super hyped, the stock split. Imagine waking up to find your shares literally doubled. Did you just get richer overnight? Well, a stock split simply divides your existing shares into new ones, dropping their individual face value proportionally. Like in 2004, when TCS famously sliced a single 10 rupee share into 10 1 rupee shares. To grasp the math, picture a tiny micro company worth exactly 50 rupees in total. This company starts with exactly 5 shares, each holding a face value of 10 rupees. So holding just one of those shares gives you exactly a 20% ownership stake, right? Now, if they suddenly announce a 1-to-2 stock split, what actually happens next? Here's the kicker. Your 5 shares become 10, but the face value drops to 5 rupees. Because of that, each share now represents only a 10% ownership stake, down from 20. So, the million-dollar question. Did this split magically create brand new wealth for you overnight? Absolutely not. The total fundamental value of your investment is still exactly 50 rupees. See, your share count totally doubled, but your overall investment value stayed exactly the same. If it's totally mathematically neutral, why do companies even bother executing these splits? It mostly boils down to boosting market liquidity and giving retail investors way more flexibility. Imagine needing to cash out just 2 rupees, but you only hold a single 10 rupee share. Splitting shares completely solves this. You can easily sell partial holdings while keeping the rest. Always remember the golden rule. A stock split just changes the slices, never the whole pie. Knowing the truth now, will you still buy the hype the next time a split is announced?
Let's jump right into this explainer and decode how massive companies literally manipulate time to build wealth.
Sounds impossible, right? But what if you could actually pull a profit before ever paying your bills?
It's all about the cash cycle. Basically, how many days it takes to turn raw materials into cash.
To really get this, let's look at a totally standard, everyday business scenario first. Say you start a t-shirt brand. You buy the cloth, stitch it up, and sell the shirts.
In a normal timeline, your hard-earned cash is completely trapped in that inventory for 30 days. That's a whole month where your money is stuck. You literally can't expand or invest it anywhere else.
Oh, and it gets worse. Failing companies often trap their cash for over a year, risking total bankruptcy.
But then there's the holy grail of finance. Check this out, a negative 52-day cash cycle.
A negative timeline completely shatters normal business logic. It's basically a massive corporate superpower.
Take Hindustan Unilever, for example. This consumer goods giant plays a completely different financial game.
Because they're huge, they demand materials today but agree to actually pay for them 40 days later.
Suppliers just accept this? Why? Because losing a mega buyer like Hull would absolutely crush them.
So, Hull moves crazy fast. They collect sales cash by day 7 but pay suppliers on day 40.
They even grab advance payments from distributors. They're literally getting paid before the product is even finished.
The contrast here is wild. Hull is running its massive empire entirely on its supplier's dime. This creates a core cycle of negative 33 days. Hull holds that free cash for a full month.
The crazy part? They don't even need their own capital to fund daily operations. Not a single cent.
They use that floating cash to aggressively expand or just park it in the bank to earn interest.
So this isn't just an accounting trick. A negative cash cycle is absolute proof of total market dominance.
In a normal business, your cash takes the hit. In a powerhouse business, the suppliers take the hit.
So, next time you analyze a company, ask yourself, are they funding their own growth or are there suppliers?
Welcome to The Explainer. Today, we're tackling a silent killer in the corporate world, debt versus equity.
What actually destroys massive companies when the stock market and economy inevitably take a hit? Let's dive in.
It's all about funding. See, equity means sharing the business risk, while debt means strict, mandatory repayment. With equity, a struggling business doesn't owe mandatory interest to its shareholders. You literally just share the losses. But debt is ruthless. The bank demands its interest payment, even if you make absolutely zero profit.
Now, many classes teach this dangerous myth that your debt-to-equity ratio should ideally be 2 to 1.
Why? Well, companies love debt because it artificially inflates their return on equity during those sweet boom times. Swap 50 rupees of equity for debt, pay some interest, and suddenly profits are concentrated on less capital.
Boom! That creates a highly deceptive 28% return on equity, making the company look incredibly attractive.
But this whole financial illusion completely shatters the exact moment the economy slows down and revenues drop. During tough times, shareholder dividends can easily be paused, but bank interest payments? Yeah, those never stop.
Paying fixed interest during consecutive loss-making years will rapidly bankrupt what were otherwise perfectly good companies.
So, if that academic 2 to 1 rule is a total trap, what's the actual ideal ratio for us?
For a truly resilient business, the ideal debt-to-equity ratio isn't 2 to 1. It's literally 0.
Just look at massive wealth creators like Page Industries. They operate with practically zero debt.
Zero-debt companies effortlessly survive deep slowdowns because mandatory bank payments don't suffocate them when sales drop.
But wait, is there ever a scenario where this golden rule of zero debt just completely fails?
Actually, yes. Banks and non-banking financial companies are the sole exceptions to this strict zero-debt rule.
Think about it. A bank's entire business model literally relies on taking customer deposits as debt.
So applying the debt-to-equity ratio to financial institutions gives you completely useless data. Just don't do it. Always follow this 3-step safety check. Evaluate the ratio, aim for 0, and exclude financial institutions entirely.
Go check the debt levels of your favorite portfolio investments right now. Are they secretly drowning?
Net profit? It's kind of an illusion. Welcome to our explainer on a shocking reality of stock investing. Seriously, how can a business show massive profits on paper, but then suddenly go totally bankrupt? Imagine buying pencils for 20 rupees and selling them for 30. Boom, 10 rupees profit, right? But here's the catch. The customer promises to pay next month. That profit? Strictly on paper. So despite recording that 10 rupee profit today, your actual cash in hand is literally 0. You see, recorded profit is totally meaningless if that actual cash never hits your bank account. Even stable giants like Hindustan Unilever sometimes report way higher earnings per share than actual cash flow. Now imagine a profitable cement factory. Suddenly, their heavy machinery completely breaks down. They gotta fix it. The owner has to spend hard-earned cash just to repair the plant. That's capital expenditure, or CapEx. To find real financial health, we take our operating cash flow and subtract those capital expenditures. That leaves us with free cash flow. It's the true surplus money a business can actually distribute. Let's look at the real-world financial disaster of the travel company Cox and Kings. Until 2018, their net profit was consistently positive. They looked like a super safe investment, right? Well, here's the hidden flaw. Their operating cash flow was actually negative in 4 out of 5 years. Because their free cash flow was completely negative. Those paper profits were literally just a dangerous illusion. So what happens if a company actually does collect cash? Let's check out telecom giant Airtel. Telecoms need constant capital expenditure to fix towers and upgrade tech. It's like a relentless financial treadmill. While Airtel generates massive cash, they gotta spend almost all of it just to maintain basic operations. Their free cash flow becomes practically 0 because that money stays permanently trapped inside the business. Free cash flow is the real truth. Remember, profit is an opinion, but cash is a fact. Welcome to This Explainer. Let's decode the high ROE trap and see why those numbers can actually deceive you. So, is a high return on equity always good? Well, it's often a dangerous optical illusion for investors. Enter DuPont analysis. Think of it as our ultimate lie detector test to reveal what's actually driving that number. This formula breaks ROE down into 3 core pieces: net margin, asset turnover, and the leverage multiplier. Clue number 1 is net margin. This essentially measures the pure quality and actual profitability of products sold. If a company sells at a premium, that high margin naturally drives their return on equity right up. All right, clue 2 is asset turnover. This represents the sheer speed and efficiency of the whole business machine. It basically tells us how much sales revenue gets generated for every single unit of currency invested. Fast turnover means machines are running hot. Slow turnover, that means idle assets are dragging the business down. Finally, clue 3, the leverage multiplier. This is the highly unpredictable rocket fuel of the entire operation: debt. Here's the kicker. If ROE spikes, but margin and turnover stay flat, it's artificially fueled by leverage and loans. Let's apply this framework to a real-world case study from our source material, the cooling company Symphony.
A few years ago, Symphony boasted a massive, super attractive return on equity of 34%.
But recently, that impressive ROE plummeted, dropping drastically down to just 15%. Quite the shock, right? So why did it crash so incredibly hard? Let's use our DuPont clues to figure it out. First up, their net margin dropped from 26% to 19%. That means way less profit per sale. Second, their asset turnover was literally cut in half. They were simply moving far fewer goods overall. So lower profit per sale plus fewer goods sold overall meant their return on equity totally tanked. The reality is, a genuinely healthy ROE relies on strong margin and turnover, not a debt-fueled illusion. Check your own portfolio. Is that high ROE driven by real profits or hiding a dangerous debt trap?
Welcome to This Explainer. Let's skip the noise and measure a company's true efficiency. So how do elite investors instantly spot businesses that actually use their resources well?
The secret? Asset turnover. It measures sales generated directly from physical assets.
Imagine 2 rival businesses buying the exact same 100-rupee machine. The difference is crazy. One makes 500 in sales, the other just 100.
The company squeezing way more sales out of that exact same asset wins, hands down.
Think of it like buying just one car to run as a taxi.
Right? That single car is your physical asset.
Now, apps like Ula and Uber constantly funnel customers to that specific car.
More daily rides literally means higher asset turnover. It's really that simple.
In reality, Hindustan Unilever generates 220 on a 100-rupee asset. A penny stock? Just 7.
That means penny stocks are just trapping your cash with terrible asset efficiency.
But watch what happens when turnover drops, like Symphony plummeting from 1.3 to 0.67.
We gotta be financial detectives here. Why on earth did this drop by half? Usually it's one of 2 things. Either sales tanked or they bought a massive new plant.
To find the truth, we just check their recent sales growth. Easy enough, right?
Well, looking at the data, Symphony's sales actually dropped by a massive 23%.
The reality? They were just struggling to sell things, not expanding their assets.
They were getting hit twice, suffering from lower profit margins and lower sales volumes.
Remember, the ultimate goal of any great business is maximizing output from minimal input.
So, check your portfolio. Is your money sitting in lazy assets or funding highly efficient machines?
Let's dive in and uncover the ultimate lie detector for a company's financial health, all right?
You know, relying solely on a low debt-to-equity ratio for safety, that's actually a dangerous trap.
Why? Well, if a business literally can't generate enough profit to cover its interest, bankruptcy looms.
Enter the interest coverage ratio, or ICR. It proves if a company can actually survive its debt.
Let's keep it simple. Imagine a company owes exactly 100 rupees in interest.
Now picture that exact same company pulling in 1,200 rupees in profit over the year.
That gives them a sweet multiplier of 12. They're making 12 times what they owe.
This 12x multiplier, it's exactly what Tata Chemicals nailed in their recent financial data.
But here's where beginners totally trip up. They pick the wrong profit number.
We've got to compare operating profit against net profit to see why this matters so much.
Here's the catch. Net profit is calculated after the interest is already paid out. So we absolutely must use operating profit to see if they can afford that interest beforehand.
To calculate this yourself, just grab the operating profit and divide it by the interest owed.
So, what's the magic number here? What actually guarantees that a company is safe?
The golden rule for a rock-solid company is an ICR of at least 4 to 5.
Dip below that, and you risk bankers literally seizing the company and auctioning off its assets.
Keep this checklist handy to make sure a company can comfortably service its debt, okay?
So I'll leave you with this. Go check your investments right now. Do they pass the test?
Let's dive right into this explainer on valuing asset-heavy businesses using the payback period.
Look at India's amusement parks. Imagica's nearing bankruptcy, right? But Wonderla is debt-free and exploding.
So why did the premier park crash while the regional guy thrived? It all comes down to one metric. The payback period. Literally how many years it takes to get your initial capital investment back. Let's peek at Imagica's math to see exactly how they walked right into a 14-year trap.
Imagica dropped an absolutely massive 1,700 crore rupees upfront just to build their grand park.
But thanks to Indian ticket price caps, their super optimistic annual profit barely 120 crore. And here's the kicker. At that rate, it'll take 14 years just to recover that initial capital. I mean, would you wait 14 years just to break even on your original money? No way. If you just toss that cash into a fixed deposit, it would have literally tripled to 5,000 crore. So why on earth was Imagica's upfront cost so ridiculously high to begin with? They basically tried building an Indian Disneyland. Think heavily taxed imported rides, fake waterfalls, and super pricey themes. Sure, parks abroad charge premium prices, but average families in India just couldn't afford that. Enter Wonderla. These guys took a totally different, highly efficient, and low-cost approach. They built their Hyderabad park for just 350 crore. That is a tiny fraction of Imagica's cost. How? They ditched expensive themes, built their own rides in-house to dodge import taxes, and shared staff. By slashing that initial spend, Wonderla squeezed their payback period down to just 5 years. And that ultra-short payback period is exactly how they built an unstoppable cash-printing moat. They build a park, recoup costs fast, and use pure profit to fund the next one. Easy. Plus, rivals won't risk massive capital to enter Wonderla's turf. Splitting visitor traffic instantly ruins their payback. So when looking at asset-heavy businesses, are you buying into a sustainable cash flow moat or a 14-year trap? Welcome to this explainer. Today, we're revealing the secret tool for comparing massive corporate giants with tiny startups. Seriously, how do we fairly analyze drastically different sized companies on a completely even playing field? Take HDFC Bank, making over 1 lakh crore in interest, versus IDFC First at 15,000 crore. But hey, looking purely at those raw, absolute figures, that's a huge trap for us investors. So, to instantly level the playing field, we use the powerful 100 rupee rule. Enter the common size statement. It's literally our magic decoder ring, converting all revenue to a base of 100. Because honestly, it's not about how much total cash you make, but how efficiently you use it. We just assume total interest earned is 100%, calculate expenses as percentages, and compare final profits. Doing this, we instantly see exactly where every single rupee of each bank's revenue actually goes. These percentages reveal exactly who manages their operations best, totally regardless of their absolute size. Now let's hit the balance sheet. We'll apply this exact same logic to check a bank's structural health. Banks get funds from 4 main sources: share capital, reserves, everyday deposits, or interbank borrowings. For example, a whopping 75% of HDFC's total funding comes purely from everyday customer deposits. This proves immense customer trust, which secures incredibly cheap funding for the giant bank. Contrast that with smaller banks, which might be forced to rely on expensive borrowing just to survive. Ultimately, the highly efficient small companies of today are going to be the massive market giants of tomorrow. So ask yourself, in your portfolio, are you hunting for today's biggest company or tomorrow's most efficient? Let's build your forensic toolkit, decode those quarterly earnings, and find the real truth behind the numbers. Ever wonder why solid stocks plummet after earnings? Well, taking those numbers at face value is a huge trap. Take Wonderla's sales crash in September. Yikes, right? Does that mean the entire amusement park is failing? Not at all. The real culprit here is just the reality of business seasonality. See, June means summer holidays and massive sales, but September brings heavy monsoons, so attendance naturally plummets. So comparing the September quarter straight back to June, completely flawed for seasonal businesses like this. The golden rule here, you absolutely must use year-on-year comparisons to uncover the actual truth. Even for super stable consumer goods like Hindustan Unilever, comparing this quarter to last year is best. Why? Because it completely filters out temporary noise, like a crazy spike from a random product launch. But what if the numbers are intentionally manipulated? Let's dive into the dark side of earnings pressure. Missing targets crashes stock prices. So how do desperate managers actually manage to fake their sales? Let's break down exactly how these managers pull off a massive accounting illusion step by step. Step 1. It's December 30th, and they ship out excess inventory to a super friendly distributor. Step 2. The quarter officially ends December 31st. Boom! 2 crore rupees in fake sales gets booked. Step 3. January 1st hits. That distributor simply returns those goods as a standard sales return. The December quarter looks amazing. The stock rises, insiders sell, and everyday retail investors get totally trapped. So, how do you spot this trap? Well, your ultimate weapon isn't the profit and loss statement. It's actually the cash flow statement. Companies can easily inflate reported sales, but they cannot fake cash. Look at real data. Godrej reported 4,900 crores profit and actually received 4,750 crores cash. That's trustworthy. But Lovable reported 50 crores profit with just 21 crores in actual cash. Very suspicious. So next earnings season, will you blindly trust the net profit margin or follow the actual cash?
Okay, let's unlock the hidden treasures buried deep inside corporate annual reports.
Honestly, reading a 200-page document feels like hacking your way through a totally tedious jungle.
But guess what? You only need 3 key things to instantly gauge a stock's actual health.
Here's the roadmap: MD&A, shareholding patterns, and finally, contingent liabilities. Let's dive in.
First up, the management discussion and analysis. This is where the big bosses reveal their actual mindset. You'll spot a wild dual narrative here, predicting huge industry growth while quietly exposing real business risks.
They literally have to disclose threats, like soaring raw material costs or aggressive new competitors moving in.
All right, our second gem reveals who really pulls the strings, the true company ownership.
So ownership usually breaks down like this: promoters, big institutional investors, and, well, the general public.
Take Zydus Wellness, a massive 67% promoter holding that shows absolute trust in their own business.
And look at Tata Chemicals. Seeing promoter ownership rise quarter over quarter is a hugely positive signal. Now, our final treasure sounds super intimidating, right? Contingent liabilities.
But it's actually simple. Just think of it as a hidden financial landmine that hasn't exploded yet.
Check out this stark reality, a potential 65 crore rupee financial blow waiting in the wings.
Zydus Wellness has a pending sales tax case. If they lose that battle, they literally have to pay up.
So always use this checklist. Read the MDA, track those owner trends, and hunt for those hidden liabilities.
Makes you wonder, what hidden risks are lurking in the annual report of your favorite stock right now?
Let's jump right into this explainer. Grab your magnifying glass because we're becoming financial detectives today. Ever wonder why massive companies go belly up while tiny competitors crush it? Let's uncover those hidden clues. Tool number 1, payback period. Look at theme parks Imagica and Wonderla. The cost difference? Absolutely wild. Check this out. Imagica takes a grueling 14 years to recover costs. Wonderla, just 5. For heavy-duty businesses, payback period is everything. It literally tells you when an investment actually starts making money. Wonderla kept things cheap. No fancy imported waterfalls, just smart in-house manufacturing to dodge those heavy taxes. Next up, how do we compare a megabank with a tiny one? Common size statements level the field. By treating total revenue as exactly 100%, you see exactly where every single rupee goes. Tool 3, quarterly seasonality. Sometimes a massive drop in revenue isn't a failure, it's literally just the weather. Take Wonderla again. Summer holidays mean huge sales spikes, but monsoons totally washed out their September profits. But hey, management knows we're watching. So what happens when they sneakily decide to fudge the numbers? It's basically borrowing from the future. They fake a December sale, inflate their stock, and quietly cash out. To avoid getting scammed by those tricks, Our fourth tool is diving deep into the annual report. Look at Zydus Wellness. The management discussion and analysis section reveals exactly what keeps their executives up at night. Dig a bit deeper, and you'll find contingent liabilities. Guys, these are basically hidden ticking time bombs. For Zydus, it was a massive 65 crore sales tax dispute hiding right there in the fine print. If they lose that court case, it absolutely crushes their bottom line. You gotta know this before investing. So the big takeaway? Always use these 4 analytical tools to protect your hard-earned cash. Next time you hear a hot stock tip, will you blindly trust it or play the financial detective? Hey, welcome to The Explainer. Let's decode how to value those crazy, loss-making digital startups. Crazy fact, Amazon didn't make a single rupee of profit for its first 20 years. Wild, right? So how do we even value them? Let's see why traditional metrics totally fail here. Old school businesses build physical factories for quick profits. Startups, they write code to capture entire nations. Think about it. A local sweet shop just competes locally, but an internet platform, it's everywhere simultaneously. Because of that borderless reach, it's a brutal winner-takes-all game. Seriously, only 2 or 3 players survive. So they intentionally burn mountains of cash. Why? To slash prices and literally destroy the competition. That's why traditional PE or PB ratios fail. It's literally like using a thermometer to weigh yourself. We need a completely new toolkit. 3 pillars: the right focus, user acquisition cost, and replacement cost. First up, focus. Is the management actually chasing the right long-term goals or just chasing hype? Take a food app. Driving real order volume is key. Just hoarding restaurants without orders? Totally useless. Watch out for red flags. Squeezing users for revenue too early? Boom, they'll lose their market share. Pillar 2, user acquisition cost, or UAC. Basically, how much cash are they burning per new customer? Compare an app growing naturally, organically, to one that's literally bribing you with free bonuses to sign up. If they're heavily subsidizing users, that's a massive red flag. Their product might not actually be sustainable. Finally, pillar 3, replacement cost. This one is super provocative, but it is an absolute game changer. Imagine a hot new digital startup is suddenly valued at, say, 7,500 crores. Ask yourself, if I handed you that exact cash, could you just build a better app? Because if you can easily replicate the whole shebang, their valuation is pure hype, no real moat. So, shift your mindset. Forget short-term losses. Focus purely on market capture, user costs, and replacement value. Next time a massive unicorn IPO drops, which toolkit are you going to use to find the truth? Welcome to The Explainer. Today, we're playing financial detective to uncover a company's true health. Let's dive in. Does a high return on equity automatically guarantee you found a great investment? Nope. Often, those amazing profit numbers are just an accounting mirage, masking serious financial trouble. We'll crack the case using 3 advanced tools: DuPont Analysis, the cash cycle, and free cash flow. Let's kick off with DuPont Analysis. It's basically a massive magnifying glass for return on equity. It breaks ROE down into 3 key drivers: profitability, efficiency, and financial leverage. Debt. The big takeaway? An ROE pumped up by heavy debt is a massive, dangerous trap. Our second tool is the cash cycle. This measures the real timeline of your cash. Imagine a tailor buying cloth, stitching, and selling. It takes 30 days to see that cash again. Compare that. A bad penny stock traps cash for a year, while Hindustan Unilever gets paid instantly. Home boasts a negative 52-day cycle. They literally get paid before they even pay their suppliers. Finally, remember this. Booked profit means absolutely nothing if your customer's check bounces. Free cash flow is king. Operating cash flow minus capital expenditures equals real money in the bank. Take Cox and Kings. They reported fake paper profits, bled actual cash, and completely went bankrupt. Even honest companies like Airtel struggle because constant tower maintenance just eats up their free cash. So, smart investors never trust surface-level ROE. They dig for short cash cycles and unfakeable cash flow. So ask yourself, do your portfolio companies generate real free cash flow or just an accounting illusion? Welcome to This Explainer. Let's jump right into analyzing banking stocks and totally demystifying those complex numbers. So how do we spot the real winners? It's simpler than you think. Just track one currency note. Seriously, you can understand a bank's entire business model through a single 100 rupee note. First up, how does the bank actually get that $100? That's your CASA ratio. Current accounts cost banks 0 interest. Savings accounts? They cost around 3.5 to 4%. Kodak actually boasts a higher CASA ratio than HDFC. But hold on, what's the true cost? HDFC's overall cost is lower, meaning their 100 rupees is way cheaper to acquire. Okay, so they have your money. How on earth do they turn a profit? Enter the net interest margin, or NIM. This is the core profit engine of any bank. Take deposits at 5%, lend at 12%, keep the spread. HDFC maintains a solid 4%. Those loans they give out, those are the bank's assets, which leads to return on assets. For a genuinely healthy bank, the absolute bare minimum ROA you want is 1%. Look at HDFC here. They perform exceptionally well, creeping right up to that elite 2%. But here's the million-dollar question. What happens if those borrowers just never pay it back? We measure this massive risk using net non-performing assets, basically loans that go completely bad. Out of 100 rupees, HDFC loses just 40 paise. Central Bank loses a staggering 8. A consistently low NPA proves the bank actually knows who is safe to lend to. Finally, how does a bank guarantee its future growth? That's your capital adequacy ratio, or CAR. A CAR around 17% means they have plenty of fuel to safely blast off. Anything at 12% or lower is a massive red flag, choking the bank's growth. Okay, let's tie it all together. You'll want to build a quick spreadsheet comparing these vital signs. Your goal? Find a bank crushing these fundamentals, but still trading at a lovely discounted price. But please, don't just stop at the spreadsheet. You absolutely have to check the qualitative stuff too. If numbers were everything, algorithms would be billionaires. The real-world context behind the loans is everything. You can track the money now, but are you truly ready to spot those hidden management red flags?
All right, let's jump right into this explainer and uncover the secret to spotting a company's economic moat.
Ever wonder why giants like Kodak totally fail, while companies like Geo and HDFC just keep thriving? Well, markets are ruthless. Over 75% of the top companies from 25 years ago literally vanished.
The survival secret is an economic moat, a giant fortress shielding a business from invading competitors.
So, let's break down the fortress framework. These are the 7 ultimate defenses companies use to survive. First up, government protection. Sometimes, the government steps in as your absolute best shield against new rivals.
Think rating agencies like Crystal or explosives manufacturers. They have strict licenses. Competitors literally just can't enter.
Moat number 2 is low cost. The real game changer here is owning your entire supply chain.
If a cement plant actually owns its limestone mine, they produce way cheaper and absolutely dominate.
Our third moat, distribution reach. This is all about how insanely fast you can access consumers.
Hindustan Unilever reaches every corner store. They can launch a new sanitizer nationwide in a flash.
The fourth defense is brand power. This is built purely on deep, unshakable trust from us, the consumers.
Brands like Maggi, Saffola, or Dettol can easily launch new stuff simply because you already trust them.
Moving into tech, Moat 5 is patents. That's a massive legal barrier stopping anyone from copying you.
Apple patented curved glass for the iPhone X, basically forcing rival Androids to keep those clunky bottom bezels.
But hold on, why did a massive tech giant's product like Google Plus fail completely?
It lacked Moat 6, the network effect. You know, a platform is totally useless without your friends.
We use Instagram because everyone is there. Recruiters use Naukri because all the job seekers are there.
Which brings us to our final concept. Why don't you ever switch banks for better interest rates?
Well, that's Moat 7, switching costs. You're practically trapped by the sheer inconvenience of leaving.
Whether it's EMIs tied to HDFC or corporate IT from TCS, leaving is just way too painful.
So these 7 economic moats are those unbreakable shields guaranteeing a company's long-term survival.
When you're analyzing your very next stock investment, I'll leave you with this. Which moat will you look for?
Hey there, let's dive right into this buzzword-heavy stock market topic, corporate actions. You hear bonus or discount and instantly think jackpot, right? Well, is it really free money? Let's get things off with stock splits. Think back to when TCS did this in 2004. The math is super simple. One 10 rupee share becomes 10 1 rupee shares. The value drops proportionally.
But here's the kicker. Your overall ownership percentage in the company, it stays exactly identical.
Cutting a pie into more slices doesn't magically make more pie. It definitely doesn't double your wealth. Now, moving on to bonus issues. The name sounds absolutely amazing, right? Literally free shares. Yeah, it's a total illusion. The book value per share just halves. You gain zero extra wealth. So if it isn't free money, why do companies even bother? Let's look at an extreme example. Imagine trying to buy a single share of MRF at this massive 57,000 rupee price tag. Basically, companies do this to make shares affordable, boost liquidity, and let you sell off smaller chunks. Okay, now for the trickiest one, rights issues. This is where things get genuinely complicated for us. Why do experts often call this a trap? Let's break down the exact math and see. Pre-issue, a company makes a 300 rupee profit on 100 shares. That's 3 rupees EPS. They issue 2 rights per share. Boom, now there's 300 shares, but still only 300 rupees profit. Notice how your earnings per share completely plummets from 3 rupees down to just 1. So the company offers you new shares at a steep discount of 60 rupees. Sounds awesome, right? Not really, because the total shares tripled. The actual intrinsic value per share got completely diluted. If you buy in, you're literally paying extra money just to maintain your original piece of the pie. But if you don't, your existing investment bleeds value because everyone else is buying those diluted shares. So, to recap, splits and bonuses are totally neutral math. Rights issues, they can actually dilute your wealth. Next time a corporate action pops up, ask yourself, are you chasing free money or true company growth? High dividend yields look like free money, right? Today's explainer reveals why they're often a massive trap. Is that guaranteed passive income actually destroying your long-term wealth? Let's dive into the fundamentals. Here's the deal. Fast-growing companies reinvest their profits to expand, while stagnant ones just pay out cash. Let's look at a stock offering a massive 10% dividend yield. Sounds like a total golden goose. Take Indian Oil Corporation, for example. A 10% yield sounds like amazing passive income, doesn't it? Across their massive shareholder base, that's a staggering 14,000 crore rupees being paid out. But as smart investors, we gotta ask the crucial question. Where is this massive pile of cash actually originating? The shocking reality? It's often borrowed. IOC holds over 116,000 crores in debt. Seriously, why would a company borrow billions at high interest rates just to hand you a dividend? Often, it's just to artificially prop up the share price, creating a total illusion of financial health. This debt trap creates nasty hidden costs beneath the surface that secretly eat away at your actual wealth. Remember, a dividend isn't a bonus. It's literally just your own money handed back to you, then taxed. This triggers the ex-dividend drop. The share price automatically falls by the exact amount paid out. Look at the 5-year trend here. The share price barely moves, meaning absolutely zero capital growth for you. Throw in the steep income tax you pay on that dividend, and your real returns shrink even further. So, if high yields are a trap, how should a fundamentally sound company reward its loyal investors? Enter the much superior, tax-efficient alternative favored by top wealth creators. We're talking about corporate share buybacks. By buying back its stock, the company reduces supply, directly increasing the intrinsic value of the shares you hold. To build real wealth, check the fundamentals. Look for low debt, profit reinvestment, and consistent share buybacks. Ultimately, are you investing your hard-earned money just for taxable payouts or for true, compounding wealth? Welcome to this explainer. Let's decode how to figure out a company's true value before you invest. You'd think a stock's sticker price gives you the whole story, right? Well, it definitely doesn't. Market cap is literally just the baseline price tag to buy every single share of a business. Picture this, you're walking in a local shop and the asking price is exactly 100 rupees. But you crack open the shop's safe and boom, there's 20 rupees of cash waiting for you. Here's the secret. Getting to keep that cash basically gives you a direct discount on the purchase. But wait, plot twist. The old owner left behind a 10 rupee debt that you've got to pay off. Let's crunch the numbers real quick and build our true cost equation. So, after all that math, your absolute true cost for the shop is just 90 rupees. In the stock market, we officially call this true cost formula the enterprise value, or EV.
Market cap, total illusion. Enterprise value reveals exactly what's hiding under the hood: cash and debt.
Let's look at a pretty stark real-world example from our source material, AdLabs Entertainment. At first glance, AdLabs looks like a total steal with a tiny market cap of 22 crores. But check this out. They're sitting on a massive, hidden debt of over 1,000 crores. Slap that debt on, and your true enterprise value skyrockets to 1,100 crores. Definitely not cheap. This perfectly shows how EV saves you from blindly walking right into a massive debt trap. Now, let's flip the script and look at a hidden treasure mentioned in the source, NBCC. NBCC has a pretty straightforward sticker price. We're talking a market cap of 2,800 crores. But get this. Sitting right there in NBC's bank accounts is a staggering 5,000 crores in cash. Even better, zero debt. Subtract that giant pile of cash and watch the valuation completely flip. You literally get a negative enterprise value. You're basically getting paid to acquire the company. Crazy, right? A negative EV means the cash inside the business is actually worth more than the business itself. So the ultimate takeaway? Debt destroys value for buyers, while huge cash reserves create absolute bargains. Next time you're analyzing a stock, always run the EV math. Find that genuine price tag. Take a hard look at your portfolio today. Are you holding hidden treasures or just expensive debt traps?
Welcome to The Explainer. Forget surface-level profits. Today, we're running a financial X-ray on true operational health.
You see massive profits, right? But hey, is that really enough to prove a business is totally secure?
The reality is, sky-high profits built on dangerous debt, that's literally a massive hidden trap for us.
So, let's dive into our first vital sign. It's efficiency, measured by a company's asset turnover.
Think about two identical machines. The one pumping out 5 times the sales is obviously way better. It's exactly like the Uber model. Squeezing more rides out of one car means insanely high asset turnover. But man, look what happens when that efficiency totally breaks down, kind of like it did for Symphony Coolers. For every single rupee of asset, their sales plummeted from 130 down to just 67 paise. That drop means either their sales fell off a cliff or they built a completely unused factory.
Next up, the company's cholesterol, the debt-to-equity ratio. This bad boy reveals the true financial risk.
Crazy enough, piling on debt can artificially inflate a company's return on equity, totally masking the danger. Like using half debt might show a 28% return compared to just 20% without it. But here's the huge catch, guys. Interest has to be paid even if the company loses money.
And honestly, that's exactly why the ideal debt-to-equity ratio for us cautious investors is simply 0.
Massive wealth creators like Page Industries. They run with practically zero debt, completely minimizing their bankruptcy risk.
Now, if they absolutely must hold debt, our third metric, interest coverage, checks if they'll actually survive it.
Check out Tata Chemicals. They rake in 1,400 crores in profit, but only owe 108. This literally means their operating profit is a massive 12 times larger than their actual interest expense.
With 12 times coverage, they can comfortably survive downturns and easily pay off those mandatory bank obligations.
As a super safe benchmark, you always want to see an interest coverage ratio of 4 or 5.
All right, so before you invest any hard-earned cash, always run this complete diagnostic X-ray on the business.
Verify their efficiency, make sure debt risk is super low, and confirm they can survive those interest payments. Nailing these 3 fundamental vitals, that is your absolute key to safe, long-term wealth creation.
So, look at your own portfolio right now. Would your top stock survive this X-ray or just shatter?
Hey there, let's dive right into this explainer and decode 2 investment metrics that actually matter, ROE and ROCE.
High returns? They can totally be a mirage. We've got to uncover the truth behind those dazzling numbers. Basically, think of equity as your own hard-earned cash, while debt is just money borrowed from a friend. So, return on equity, or ROE, only measures the profit generated using your own invested money.
For example, invest $100, make 20 in profit, and boom, your ROE is 20%.
But here's the tricky part. Borrowing money can completely manipulate this exact metric. It's a total illusion.
Watch what happens when you split that initial capital and take on some borrowed debt instead.
Pay $6 interest, leaving 14 in profit.
But on just 50 equity, your ROE jumps to 28%.
See, this perfectly illustrates how just taking on debt can artificially inflate a company's return on equity.
To dodge this debt trap, we use ROCE. It includes that borrowed friend's money in the overall calculation. The real secret to spotting the difference? It lies entirely right here in these two mathematical formulas. Notice how ROCE uses operating profit? That's because it measures pure business efficiency before subtracting debt interest.
Let's look at real-world balance sheets from our sources, Hindustan Unilever and Cadila Healthcare.
Hindustan Unilever carries zero debt, so their massive 82% ROE gives us a really accurate, reliable picture.
Cadila, though, holds 3,000 crores in debt. Those heavy interest payments are going to completely skew their ROE.
The golden rule here, trust ROE for zero-debt companies, but always switch to ROCE for high-debt ones. Next time you invest, ask yourself, is that amazing return genuine or just a mirage built on borrowed money?
Welcome to this explainer. Let's uncover why paper profits might actually be lying to you. Most investors just glance at net profit and assume everything is fine. But is it? Spoiler alert, you guys, stated profit on a P&L is often just an accounting illusion. Imagine a local shop selling 2,000 rupees of goods daily, but entirely on credit. The P&L shows a solid profit, right? But the actual cash register is totally empty. If those customers default, that booked profit just vanishes. It was literally a paper illusion. So how do we actually protect ourselves from falling for this kind of accounting trap? The answer? The cash flow statement. It's basically your ultimate financial lie detector. You've got to directly compare that stated net profit against the actual operating cash flow. Let's look at a real-world example from our source data, a brand called Lovable Lingerie. Over 5 years, they reported an incredibly impressive 50 crore rupee profit. Sounds great! But the actual cash hitting their bank account? Just a mere 21 crore rupees. Yeah, less than half of their stated profit actually materialized into spendable, hard cash. Now, for a breath of fresh air, let's contrast that with Godrej Consumer. They claimed 4,900 crores in profit, backed by 4,750 crores in real cash. Super transparent. To value stocks safely, try swapping out the traditional PE ratio for the price-to-cash flow ratio. This tells you exactly how much real cash you're actually paying for a single share. For instance, Bajaj Consumer trades at 11 times cash flow, while Jyothi Labs sits at 12. This metric lets you securely compare peers using cold, hard reality instead of just paper earnings. So look past the P&L statement. Ask yourself, are you investing in paper profits or real cash?
Hey there! Today, we're unlocking a major secret of fundamental stock analysis, the P/B ratio.
So, how do you really know if a stock is actually cheap or expensive? Let's figure it out. Okay, let's dive into this. Imagine a 100 rupee shop split evenly right down the middle between two partners. If that shop suddenly closes and liquidates, each partner gets exactly 50 rupees. Pretty simple, right? That 50 rupees is the book value. It's what you'd theoretically get if a company sold every physical asset.
Now let's apply this exact same concept to a real-world heavy industry giant, Tata Steel.
Check out this massive gap. The share price is 277 rupees, but the underlying book value is 593.
If you divide price by book value, you get an incredibly low PB ratio of just 0.47.
This metric is absolutely perfect for capital-intensive sectors. We're talking steel plants, cement factories, power, and infrastructure. Why? Because these industries rely on massive, physical assets you can literally touch. PLB captures that perfectly.
But wait, does this work for everything? What about a booming IT company like InfoEdge? Look at how drastically different these numbers are. Share price is 2,000, but book value is a tiny 200. That leaves us with a whopping 10x PB ratio. On paper, that looks insanely expensive, right?
So, does a 10x ratio mean this IT stock is just a terrible financial trap?
And this brilliantly illustrates the difference. Heavy industries run on machinery, while IT runs on employees and reputation.
Here's the major pitfall. Strict accounting rules actually classify employees as expenses, not as assets on a balance sheet.
You just can't slap a physical price tag on Apple's brand reputation or a genius coder's brain.
But hey, don't toss this metric out just yet. For one specific sector, P/B is the absolute gold standard.
I'm talking about the financial sector. Banks and lending institutions. It's perfectly designed for them.
Why? Because a bank's inventory is literally just money. Cash and loans are perfectly captured in book value.
Comparing these instantly reveals how the market prices leaders, from Kotak at 6x down to ICICI at 2x. Look at your own portfolio. Are you valuing your stocks with the right metrics? Keep analyzing, and happy investing.
Welcome to today's explainer. Let's dive right in and unlock a valuation secret the pros use. So, does a low price to earnings ratio of 9 guarantee a bargain? Well, not exactly. Relying solely on PE is a trap. The missing puzzle piece is actually profit growth. Enter the PEG ratio. Just take that PE and divide it by the profit growth rate. The magic number here, 1. A fairly valued stock sits right around a PEG of 1. Under 1? It's undervalued and cheap. Higher than 1? Yeah, you're probably overpaying. Let's see this in the real world. We'll start by looking at Godrej Consumer. Godrej has a PE of 33. On the surface, man, that looks incredibly expensive. But wait, their 3-year profit growth averages a super impressive 34%. So, divide 33 by 34. Your result drops just under our magic number of 1. Surprise! Factoring in that massive growth proves Godrej is actually fairly valued. Okay, ready for a plot twist? Let's take a look at Bajaj Consumer. Bajaj boasts a super low PE of just 9. Initially, it looks dirt cheap, right? However, its 3-year profit growth is a really sluggish 4.5%. Divide that 9 by 4.5, and you get a PEG ratio of 2. So, the reality here, Bajaj is actually quite expensive and totally overvalued. This perfectly proves why looking at a low PE ratio alone is a dangerous trap. But here's a pro question. Which growth rate should you use? 3 or 5 years? Always check the most recent 1-year trend first. It tells you which average to actually trust. Godrej recently accelerated to 75%, while Bajaj just stayed stuck at 4.5. Because of these shifting trends, the 3-year average holds way more weight and reflects reality. Remember, PEG works best for sectors with highly stable earnings. Think FMCG, pharma, or IT. So I gotta ask, what's the PEG ratio of the absolute cheapest stock in your portfolio? Welcome to this explainer. Today, we're decoding the PE ratio so you can value stocks like a total pro. Let me ask you, would you pay 70 rupees up front to earn just 1 rupee a year? Imagine a shop making a 100 rupee profit. With 4 equal partners, your exact cut is 25 bucks. That's your earnings per share, or EPS. It's the exact slice of profit belonging to your 1 share. Let's look at Hindustan Unilever. A single share costs roughly 2,190 rupees, and it earns 28 rupees. To find its actual worth, we use the PE ratio. Just divide the share price by that EPS. So for Hyul, dividing 2,190 by 28 gives us a PE ratio of exactly 70. Think about that. You're literally paying 70 rupees for every single rupee HUL earns in a year. Historically, HUL's PE hovered around 40 to 50, but right now, it's spiked all the way to 70. Does this jump automatically mean it's an overpriced, terrible investment? Well, not necessarily. Let's dig a bit deeper. See, HUL's profit growth accelerated from 10 to 15% recently. The market naturally rewards that faster growth. So a high PE ratio can actually be totally justified if a company's profits are growing faster. Now consider Colgate. Its historical PE was also around 50, but it currently sits much lower, at 39. Surprisingly, Colgate's profit growth is also accelerating, jumping from 7% to an impressive 15% recently. Faster growth but a cheaper valuation, this makes Colgate a fascinating candidate to research as a potentially undervalued stock. To combine PE and growth into one simple metric, we use the super handy PEG ratio. Take Godrej Consumer. It's trading at a PE of 33, alongside a 3-year profit growth of 34%. Dividing 33 by 34 gives us a PEG ratio of roughly 0.97. That's just under 1. A PEG right around 1 signals fair value. You aren't overpaying for the company's expected future growth. The PE ratio is just the start of fundamental analysis. So, how will you value your next stock? Welcome to this explainer. Let's skip the jargon and demystify stock metrics using simple, everyday logic. In one wild study, 10-year-olds actually beat professional accountants at picking profitable stocks. But how? Well, those kids ignored complex spreadsheets and picked companies they actually understood. Common sense totally wins. So today, we're organizing all that scary financial jargon into a simple 3-part investor's toolkit. Think of buying stock like buying a shop. PE is simply the years to earn back your price. Like Hindustan Unilever traded at a 70 PE. You're literally paying 70 rupees for 1 rupee earned. Then there's price to book. If that shop suddenly goes bust, what physical assets can you actually sell? This works great for heavy steel plants, but it's pretty terrible for asset-light brands like Apple. But wait, a high PE ratio isn't always bad, especially if the company is growing super fast. Enter the PEG ratio. It divides PE by profit growth to see if that growth justifies the price. A PEG around 1 means it's fairly valued. A PEG of 2? Yeah, you're overpaying for growth. Okay, next up is profitability. How efficiently is this shop actually generating new money for you? Return on equity, or ROE, measures the profit generated strictly on your own invested money. On the flip side, ROCE measures returns on your money plus any borrowed loans or debt. Comparing these two is crucial. Taking on debt completely changes the entire equation for a business. A shop might show amazing ROE using heavy debt, but ROCE exposes that hidden risk. Finally, a quick reality check. Are those paper profits actually sitting safely in the bank? Operating cash flow tracks real, hard cash entering the bank, completely stripping away any accounting tricks. Remember this golden rule. Profits can absolutely be manipulated, but real cash cannot be faked. For instance, Cox and Kings showed consistent paper profits, but had negative cash flow before failing. Free cash flow is your ultimate safety net. It's the leftover cash to actually grow the business. Use this toolkit together. You should never rely on just one single number to evaluate a stock. So, take a hard look. Does your current portfolio survive this fundamental toolkit test?